Hello and welcome to Chapter 5. Chapter 5 is going to be a little bit of a departure from what we've done in the past. We're going to focus through the first four chapters. If you recall, we focused in on inventory, and not on inventory, but on service businesses. And we looked at different types of service businesses. And the stuff you sold was for service revenue. We did something. Well, now we're going to talk about businesses that have inventory and what happens when they have sales of inventory. And we're going to talk specifically about how you account for sales of inventory within a business. And chapter 5 is called merchandising operations. And you have two different types of merchandising operations. You have wholesalers and retailers. And we'll talk about that as we move through this section just a little bit. And bear with me as I'm getting through some of this technical stuff. Okay. The first objective, we're going to describe merchandising operations, and we're going to talk about the two different types of inventory systems in merchandising operations. What are merchandising operations? Merchandising operations, basically what they do is they buy goods buy goods from suppliers, and they turn around and resell them. So there's merchandisers all over. In commerce, you can see Walmart as a merchandiser. The new CVS is a merchandiser. The bookstore on campus is a merchandiser. Think about when you bought your book. You bought it online. Even if you bought it online, they were still merchandisers because typically they didn't make the book or print the book. They bought it from somebody else and turned around and resold it. That's a merchandiser. Now, in a broader sense, you have both wholesalers and retailers. So let's start with a retailer, and we'll go back and talk about wholesalers. Retailers are going to be like Kohl's and Walmart and Target. Any store that you see pretty much that has a storefront that you can walk in and pick stuff off the shelf and buy it for your own use is going to be a retailer. Now, wholesaler is a little bit different, and let's talk about a specific example. True Value Hardware Stores buys their stuff from a buying group or a wholesaler called Cotter & Company based out of Chicago. And what they'll do is Cotter & Company will go to different manufacturers. Let's say, for example, Cotter & Company is going to carry, in their True Value Hardware stores, they're going to try and carry nuts and bolts. Well, they're going to go to a nut and bolt manufacturer. Like, for example, there's a company called National Hardware. Well, National Hardware, this Cotter & Company is going to go to National Hardware and negotiate a contract to buy hinges, for example, that are going to be sold into the True Value Hardware stores. Well, Cotter & Company, they do that for all of the different types of hardware that goes into a hardware store and then the hardware stores. So Cotter & Company is the wholesaler, and the retail hardware stores, True Value, buys from the wholesaler. That's the distinction between wholesalers and retailers, and they have something called merchandise inventory. And when you have a merchandise inventory type business or a merchandising business, it always starts with the purchase of inventory from a vendor, and sometimes you might hear that vendor called a supplier. So if you work at a convenience store and they bring in cigarettes or candy bar or Coke or any of that sort of stuff, those are the vendors for the convenience store. And they're going to sell inventory, and they're going to sell inventory typically they're going to scan inventory out, and then they're going to collect cash from customers, or they're also going to collect with a credit card. Those are probably the two prime examples, and so here's the process. They have inventory, they sell inventory, and if they sell it on account, it's going to be accounts receivable. Then they collect cash, and they turn around and they buy more inventory. So it's an iterative process for the accounting cycle for a merchandising business. They buy inventory is the first thing, then they turn around and they sell inventory on account. That's what accounts receivable says. And then they turn around and they get their cash, and they take that cash and they turn around and they buy more inventory, and the cycle continues. Now, you notice that the difference, though, is for a merchandising company, where before we had service revenue, now we have sales revenue. And we have this new account. First, we have sales revenue, like we talked about, but we also have another account that's called cost of goods sold. And cost of goods sold is the price that they paid for the merchandise that they're selling, and the sales revenue is what they charged you. So if you went to Kohl's and bought a brand new pair of Levi's and you paid $40, let's just say it's $40 without tax, and when let's say Kohl's paid $30 for those Levi's, what they would mark in their books is they would say, I had a sale for cash for $40, and I had a cost of sale for $30. So they made $10 over and above their cost for that particular pair of jeans that they sold. Everything below cost of goods, everything below this gross profit, which is the difference between sales revenue and cost of goods sold, is considered operating expenses, like the expenses to operate the Kohl's store. Those are going to be operating expenses. And they might also have administrative expenses, which are going to be maybe for the Kohl's corporate office. So that's the difference. If they're not cost of goods sold, it's going to be operating expenses. So let's compare the two income statements between a service company and a merchandising company. The service company, as you know, the first thing is it says that we have service revenue. Go over to the merchandising company, we have sales revenue. Now notice there's this extra line, two extra lines really, in the merchandising income statement that you don't see on the service company. You have cost of goods sold. So in our example we talked about earlier, that would be the $30 for the pair of Levi's jeans. And the gross profit is the difference between the value of what you sold versus what it cost you to sell. So that's the $130,000. And you'll look at gross profit percent, and we'll cover that a little bit later in the chapter. And then the operating expenses are essentially the same, in the same dollar amount, but their profitability looks different. And you can see the difference. For service revenue, the net income is basically service revenue less operating expenses, where in the sales, in the merchandising, it's actually sales less cost of goods sold, less operating expenses gives you net income. So you have a whole new line item and then a subtotal called gross profit on the merchandising income statement. So here's the financial statements on the balance sheet. The only difference is now you've added an account called merchandise inventory on the merchandising business. Other than that, they're basically the same. Not any different at all. So what happens? We have two different types of merchandising inventories within a business. You have a perpetual and a periodic. And let's talk first about perpetual. Perpetual means that they continue to keep up with it all the time. All the time. Now let's talk about an example that's something that you might not think of relative to a retailer. If any of you have ever worked as a bank teller or went to a bank and took money out, they maintain a perpetual inventory of the amount of money that they have in their drawers. You'll see them keying in on a little machine. If you cashed a check and you got $312.43, well, they're going to take out however many bills they gave you for the $300, and however many, so maybe they gave you three $100 bills, a one $10 bill, and two singles. And then for the 43 cents, they gave you a quarter, a dime, a nickel, and 3 pennies. So what happens is they keep track of exactly how many of those things they have as the inventory goes out or comes in. The same holds true for a merchandiser. When they scanned out the jeans at Kohl's, like we talked about earlier, what they're really doing is they're relieving their jean inventory and keeping track of how many they still have in inventory. So when you're at Walmart and you buy a buggy full of groceries and you spend $200 for whatever you buy, and they scan everything over the scanner, what they're really doing is they're relieving that or taking it out of their merchandise inventory and putting it in the cost of goods sold. So that's the periodic inventory, and that's the predominant inventory that we have in our country and in businesses in general. Now, that's perpetual inventory. A periodic inventory, by contrast, is where businesses only count their inventory on occasion. They don't keep track of it. They don't do it, unit by unit and that sort of stuff. They sort of look at it. They physically count their inventory is what they do. So what's an example of that? I can think of a couple of them. If you worked at a gas station and you went out and stuck the tank, why would you stick the tank? Because even though you can kind of get an idea of how much is going on in the inventory based off of the pumps and how many gallons have gone out, the temperature and the heat and when the gas was delivered and when the temperature when you stick the tank, all those will have an impact on your inventory, and you might have to take a periodic inventory. Now another one, let's say you worked at a bar and you sold cans of beer. Well, do you keep track of every single kind of beer that you sold as you put it out. If you're looking at cans of beer, you do not. So that's kind of a periodic inventory. And maybe even a third example, maybe you work at a small business and you don't see stuff scanned out. And actually a bigger business, I can think of one. If any of you are familiar with Swaim Hardware in downtown Paris, if you've ever been in there and you buy something from them, they don't scan anything out. They write it on a little ticket and they just keep track of their inventory, and they count their inventory probably only once a year. So when they count their inventory, they're probably closed for 3 or 4 days or a long weekend, or they start doing it a little at a time. But they're using a periodic inventory system. Anytime you see someplace that's not scanning and doesn't have a computer system, more than likely is going to be a periodic inventory system. What we're going to talk about first is we're going to focus in on the accounting transactions, the debits and credits that you have in a perpetual inventory system. Remember, perpetual is keeping up with inventory all the time. You're keeping track of the inventory as you go and making certain that your inventory is square all the time. Okay, so this is an invoice. This is the start of what a transaction will be. This is going to be the form that you get, or an idea of what you're going to get, and it's going to tell you that you got something in. So Smart Touch Learning bought touchscreen tablet computers, 100 of them, from Southwest Electronics Direct. And when they bought those from Southwest Electronics Direct, they got this invoice. Now let's start up in the upper left corner with number 1. That's your vendor, Southwest Electronics. Number 2, you're the customer, Smart Touch Learning. Number 3 is the invoice date and the invoice number. And those are critical from a control perspective in a business, because you're going to key those into a computer system. And most computer systems will not allow you to pay an invoice twice with the same date and the same invoice number. That's a control mechanism. And then number 4, tells you that you have credit terms. And the way you would read these credit terms is you would say 315 net 30 days. And what 315 says is if you pay within 15 days, you get a 3% discount. Otherwise, you have to pay within 30 days and you don't get a discount. So a discount of 3% on this particular problem would be 0.03 times $35,000. Number 6 shows when the invoice was paid. Typically, that's going to be a stamp, not something written in like that, but it's going to be a stamp from somebody. And let's go down to number 5, $35,000. And number 7 tells you how much you would pay if you paid within a discount period before the 16th of June. And then the one to the right of number 7 says if you pay by July 1st, you have to pay the full invoice. So you notice a difference of $1,050 between the two. Okay? That kind of gives you an idea what an invoice looks like. And this is the trigger of putting stuff into your inventory. So the first transaction, and this one presumes that they paid cash for that. They didn't buy it on credit. So it says that they paid for the screens as soon as they came in. Merchandise inventory, we're going to debit and we're going to credit cash. Remember, we were talking specifically about a perpetual inventory system, not periodic. Now, here's one if you bought it on account. Remember, bought merchandise inventory account. We're still going to debit merchandise inventory because that's our asset, and we're going to credit accounts payable for the $35,000. Now, if they pay that within terms, if they pay that within their 15 days, we're going to take a 3% discount. So what's going to happen is we're going to reduce what we owed of $35,000. We're going to take the $35,000 less the 3% cash discount, and that's what we're going to pay. That's where the $33,950 comes from. And then we're going to take that other part of that cash discount that we had, and we're going to reduce our merchandise inventory by $1,050. And that's how an invoice would be paid. Now, if you have something called a returns or an allowance, I'm certain some of you guys have had returns or allowances. You might have bought something on the internet and it got to you and it wasn't exactly the color you thought, and you called and complained, and they said, we'll give you some money off if you keep that particular item, because they don't want it back to restock and have to deal with it and whatever it cost. That would be an allowance. But let's say you bought something and you didn't like it, or it was the wrong color or the wrong size. That's going to be a return. That's the difference. Generally, allowances are money off, whereas returns are where you specifically return the item back to the retailer or wholesaler or the online retailer for your money completely back. That's the difference between the two. So for Smart Touch, it looks like they bought some. So they got some tablets that they didn't order. They sent them 20 too many, 20 higher than what they were supposed to. So they're supposed to get 330. They got 350. And they said, well, we're sending these back. Well, when they send them back in a perpetual inventory system, they're going to reduce their merchandise inventory, but they're also going to reduce what they owe by what they sent back. So that's why you have a debit to accounts payable, which the normal balance would be a credit. So we reduce it, we have to debit it. And we have a credit to merchandise inventory because we don't have those tablets in our inventory anymore to sell. Now, okay, this is kind of a tricky one, and I want you to think about this. There's something called free. FOB stands for free on board. And what it really boils down to is a couple things. First, who takes title to the product and who pays for the freight? So let's focus first on the left side. If it's FOB shipping point, or from the seller, is FOB shipping point, then the buyer pays the freight. And if it's FOB destination, the seller pays the freight. You see, pay close attention here. FOB shipping point, the buyer owns the goods. FOB destination, the seller owns the goods. So if this truck were to crash here, the buyer would have to work through their insurance company to get it taken care of. And if it were to crash here, the seller would have to work through its insurance company to get the goods paid for. And what also happens is the seller pays the freight and FOB destination. So FOB destination, seller pays the freight, FOB shipping point, the buyer pays the freight. There's the difference. So here's a FOB shipping point, where the buyer pays the freight, and it was $60. So we're going to debit merchandise inventory for $60, and we're going to credit cash for $60 because the buyer is paying the freight. Now, if we have freight in with a discount period, let's see what happens here. They had merchandise inventory of $5,000 plus $400 gets you $5,400, and then you have accounts payable with $5,400. So this is one where they had an invoice that came in for $5,000, and it had another freight of $400. Well, here's what happens when you pay that. Notice what happens here. You're going to extinguish your accounts payable, the $5,400. But what you're doing here, you would have paid $5,400 cash, but we're taking a 3% discount on this $5,000. You don't get a cash discount on the freight. You just get it on the invoiced amount of $5,000. So that's where the $150 comes. And there your journal entry balances your debits and credits. $5,400 reduction in payables, $5,250 in cash, and the other $150 goes to reducing the merchandise inventory. Now, how do we deal with cost of inventory and purchases? We look at what's our net cost of purchase. Purchase cost of inventory, less returns and allowances, less purchase discounts, plus freight in. So we're looking at what was the value of what we bought, plus the reductions for purchase returns and allowances, and less the purchase returns and allowances, less purchase discounts, plus freight in, to come up with our net cost in inventory. Okay? Learning objective 3. Account for the merchandise inventory for the sale of merchandise inventory. Well, how do we deal with sales? Sales has two parts. If we sell something on account, in other words, we're going to expect to get money for it in the future, that's going to be sales rep that we're going to have an accounts receivable, and we're going to debit accounts receivable and credit sales. They're the same as in the service business. The only difference is it's called sales revenue, not service revenue. And the other difference is that you're going to have accounts receivable. Well, those are the same, right? I'm sorry. But now the next part, you have a second part of that entry. You have to record cost of goods sold, and you also have to record a reduction in your inventory. So you're going to credit inventory and you're going to debit cost of goods sold for the value of what the inventory cost you when you acquired it. That's how you get your gross profit. So let's look at the journal entry here. Here's an invoice. So it says, it doesn't say this, but Smart Touch Learning
sold touchscreen tablets to, it doesn't tell you here, but they sold touchscreen tablets, $500, $1,000 worth. So they know that that's a sale, and we're going to take them out of inventory at the value that we paid for them. So what we have is, we have a cash sale of 1,000, and we have sales revenue as a credit for 1,000, and then we have a debit for cost of goods sold of 700 and a credit for merchandise inventory. And where did that 700 come from? The 700 came from 2 tablets at $350 each. We're reducing our inventory because we no longer have 2 of those tablets, and we're increasing an income statement account called cost of goods sold. The difference between sales revenue and cost of goods sold is gross profit. So gross profit for this example is 1,000 less 700, or $300, and the gross profit percentage is going to be 300 divided by 1,000, or 30%. So it says for every dollar you sell, you're actually getting 3 cents back to cover, or 30 cents back to cover your selling and administrative expenses. Okay, so here's another one, but this one's on account, and it looks like they sold 10, and they also gave terms, 210 net 30. Just like our vendors or our suppliers can give us terms, when we sell product, we can also give terms, in other words, credit terms, to our customers to induce them to pay faster. So those are the credit terms, and what it says is we send it to them on the 21st, and if it's 210, they really need to pay us by July the 1st or thereabouts in order to get a 2% discount on what they owe, or 2% of the 5,000, or about $100. And here's how that looks. They paid in their terms. They paid on June 30th, which is 9 days, and they're going to pay us $4,900. Not the 5,000 they owe us, but the 5,000 less the 2% discount gets you $4,900. And then we're going to debit sales discounts, 5,000 times 0.02 for $100. And we're going to reduce our accounts receivable by $5,000 because they no longer owe us. And the sales discount, and we'll cover this in a minute, but the sales discount is a contra revenue account. Contra meaning that it's opposite the normal balance of the revenue account. It's a debit balance. Revenue accounts, which sales would be, or sales revenue would be, the normal balance would be a credit, but in this particular example, in sales discounts is always going to be a net debit balance. And you have the same kind of example with sales returns and allowances. That's where you give a discount on the price for damaged or quality or color or something different about the product, and that's an allowance. And the return says that you're sending the stuff back, and that also is going to be contra. And the reason it's contra is because those accounts are classified as revenue accounts, but they are going to have a debit balance. So here's a couple of examples for sales returns and allowances. Sales returns and allowances, the customer sent $1,500 back, and so they owe us $1,500. But when we do that, what we also need to do is put those products back in inventory at their cost. So it looks like they sent us back 3 tablets, and the cost is 3 times 350, or 1,050, and the revenue change is 3 times 500, or $1,500. And if you have returns and allowances, if you give an allowance, it's going to be a debit to returns and allowances and a credit to accounts receivable. They didn't send anything back, but they said, we want to keep this one even though something is wrong with it, we're willing to keep it. That's going to be a sales return for our customer. And then here's one more with the allowances with the discount period, which we talked about earlier. And we said it was a 2% discount from the invoice. So we're going to take the $3,400 less the $68 that the company earned as a discount, or $68, excuse me, and they're going to pay us $332, and they're going to get a sales discount of $68, and our accounts receivable is going to go down by $3,400. Okay? And then when we ship something to a customer, if we are paying the freight for it, that's going to be a delivery expense for us shipping the product. And we are talking specifically here about a perpetual inventory system. And if you look at net sales revenue is going to be sales revenue less sales returns and allowances minus sales discounts. So to come up with gross profit, you're going to take net sales revenue less cost of goods sold to come up with gross profit. And here's the net sales revenue with the calculation for us. First, you can see the math: 297.5 less 11,200 less 5,600 gets you 280,700. And then we had cost of goods sold of 199,500. So the gross profit is 81,200. Now we'll look at gross profit percentages a little later, but gross profit percentage is going to take the 81.2 divided by the 290 that you saw on the top. Now to adjust and close the accounts, this is going to look very similar. You have a little bit of inventory shrinkage, which means that you go out and you count your inventory and you compare that back to your perpetual. And the difference between the physical and the perpetual is going to be some type of shrinkage. And it could be theft, damage, or just inventory errors. So theft in a retail business is going to be shoplifting, or it could be damage. And a lot of times in a supermarket, damage might be that's what the stock boys want to eat. And you might have errors in inventory for one reason or another. And a lot of those errors come from unit of measure issues, which I'm not going to get into here. But you make an adjustment to that physical inventory. And when you close this, and I know this is really small, but the only difference is we're closing the temporary accounts, which is going to be dividends, all the way down to income tax expense. We're going to close those into the retained earnings account. And we're going to, wherever you have a normal balance of a debit, you're going to credit it. And where you have a normal balance of a credit, like sales revenue, you're going to debit it. But all those ultimately collapse into retained earnings. And here's what the journal entry looks like. And you can see this in your book. It's Exhibit 5-6. If you want to take a look at this, it's basically the same. The only difference is you see these three accounts, and the accounts in blue are the only things that really change from what you saw in the other chapters when we did service businesses. Now we've added sales returns and allowances, sales discounts and cost of goods sold, and then we have delivery expense, but we also have up here sales revenue. So the first thing we do is close sales, then we close expenses, then we close the income summary account into retained earnings, and it looks like this business made $21,420 last whatever time period this is, and then we're closing the dividends. And what we're going to do is we're going to credit dividends and we're going to debit retained earnings because that's the distribution of profits. So the financial statements for a merchandiser, we can do a single step or a multi-step. And here's a single step. It doesn't isolate out cost of goods sold in a single step. So where you can calculate gross profit, that's the biggest. There's a couple differences here. You do not have a gross profit calculation. It's just everything here is expense. It's less meaningful to the inside part of the business, and even to the external business. The financial statements are not nearly as readable and understandable. So typically a business is not going to use a single step income statement. They're going to use this multi-step income statement, and there are going to be a couple of different breaks. The first thing they're going to do is they're going to use cost of goods sold and come up with the gross profit. And they're going to break down their operating expenses between selling expenses and administrative expenses. And when you hear announcements on the radio most of the time with the business, and they say, we are going to downsize and we're going to eliminate administrative positions, that's this stuff down here. And almost, if you're going to be in accounting, or you're going to be anybody that's kind of a scorekeeper of the business, as opposed to somebody that actually touches the product or handles the product or does something with the product, you are going to be in this category from a salary perspective. And if you say, well, we're going to cut administrative costs, and you're an accountant, guess what? You are in play, and they may get rid of you. That's what that means. A multi-step income statement separates selling expenses and administrative expenses, and it also looks at operating income. That's what we just talked about. And you have other things. You have other revenues and other expenses. And the last section of the income statement also has income tax expense, because that's what they owe Uncle Sam. The statement of retained earnings and the balance sheet are pretty much the same. The only difference is you have a merchandise inventory account on those. Now, what do we look at for gross profit? We can look at gross profit to evaluate business performance, and you can look at it common size. Gross profit is a common size number. If we look at two different businesses, one is really huge and one is really small, from a cost of goods sold and a revenue perspective, it doesn't matter if you want to know what the business looks like from a profitability perspective. 29% is 29% is 29% if you're JCPenney, or if you're a little mom and pop store in Mount Pleasant, let's say. You can look at the gross profit between the two, which is still the difference between your sales revenue and unless your cost of goods sold gives you gross profit, and you're going to take that gross profit dollar amount and divide it by net sales. And that's the calculation you're going to see here. Gross profit percentage is gross profit divided by net sales revenue. And the higher the gross profit, the better your business is doing in general terms. Okay? We're going to talk just a second about a periodic inventory system because I want you to be exposed to this because most of you are going to take Accounting 222 with me in the fall, and you're going to have a different, or in the spring, and you're going to have a different series of accounts that you're going to use to account for inventory in a periodic inventory system. And remember, the key word in a periodic inventory system is you're going to use an account called purchases, and that's an income statement account, not a balance sheet account. And wherever it says merchandise inventory, you want to substitute either purchases, purchase returns and allowances, or purchase discounts. And where it says where you have freight in, where you had merchandise inventory, now it's going to be freight in. And here's what some of the transactions are. You notice purchases. You bought this inventory, $35,000. You're going to debit purchases and credit accounts payable. And then when you pay it within terms, you're going to debit accounts payable, credit cash, and then you're also going to credit an account called purchase discounts. Whereas this one in the perpetual inventory system would be merchandise inventory. This one would be also merchandise inventory. Now it's purchases and purchase discounts. And then you have purchase returns and allowances. Before, in a periodic inventory system, that would go to merchandise inventory, where now it's going to go to purchase returns and allowances. And our net purchases are going to be plus purchases minus purchase returns and allowance minus purchase discounts gives you net purchases. And then we also have freight in, which is also an income statement account. And we don't, in a merchandise inventory, we don't keep a running tab in a periodic inventory system of what our inventory is. And we don't we won't record cost of goods sold until the end. And we can have sales discounts, returns, and allowances are the same. And these are the accounts that we're going to close on the income summary for a periodic inventory system. And I'm not going to go through all this, but you can see basically anything from dividends down, and you can see this in Exhibit 5A1 in your text, and it'll show you what accounts. And there's how you close the accounts. And there's one more thing I want to touch on, and I'm just going to bring this screen back up. And this is something that, if you're listening to this, I want you to write this down because this is going to be a formula that you're going to use, because we don't have a calculation in here about how to calculate cost of goods sold in a periodic inventory system, but you're going to have to know this formula in Principles 2, and it'll help you immensely if you write this down as I talk about it today. To come up with cost of goods sold in a periodic inventory system, you're going to take beginning inventory plus net purchases. Remember, net purchases are purchases, less purchase returns and allowance, less purchase discounts. And you're going to add beginning inventory plus net purchases gives you goods available for sale. And then what you physically count is ending inventory. So you're going to take that goods available for sale number, which is, remember, beginning inventory plus net purchases gives you goods available for sale, less your ending inventory, and that's going to give you cost of goods sold. So when you start and you look in Accounting 222 and you take that class, you're going to need to know the periodic inventory model and the periodic inventory formula. Remember, again, beginning inventory plus net purchases gives you goods available for sale, less ending inventory gives you cost of goods sold. Remember that formula, and you'll be glad that you did. That's the end of Chapter 5. I hope things are going well for you in your semester, and we'll talk again soon. Thank you. Bye.